If you've ever looked into building a diversified portfolio, you've likely come across several strategies like the 3-fund lazy portfolio, Bill Bernstein's no-brainer portfolio, and Ray Dalio's all-weather portfolio. They're all fantastic options, but what if you could simplify even more? What if one ETF could be your entire portfolio? In today's video, we'll dive deep into the world of multi-asset ETFs. I've researched and gathered information on 11 such ETFs that could potentially streamline your investing strategy into just one trade. As always, we'll talk about the pros and cons of owning such single one-trade portfolio before we compare those 11 ETFs. So what is a One Fund Portfolio? A One Fund Portfolio contains a single mutual fund designed to be a complete investment solution. And these funds are typically multi-asset, meaning they include a mix of asset classes like stocks, bonds, cash, and sometimes even real estate. The allocation among these assets is preset to target specific returns and is automatically rebalanced periodically. You might hear these called multi-asset funds, asset allocation funds, premixed funds, and ready-made funds. And there are primarily two types of strategies within One Fund Portfolio. Number one is the target date funds. And target date funds are ideal for investors who know when they plan to retire and start withdrawing their money. When retirement is far off, these funds might take on a more aggressive investment approach, leaning heavily on stocks for greater growth potential. As the target retirement date gets closer, the fund strategy shifts towards more conservative investments. For instance, in Australia, many superannuation funds offer life cycle options that automatically adjust your asset allocation as you age. The second type of the One Fund portfolio is the target allocation funds. Unlike target date funds, target allocation funds remain a constant asset mix regardless of the time horizon. For example, if a fund is designed with 80% stocks and 20% bonds allocation, the fund manager will actively adjust the portfolio to maintain this ratio over time. And this strategy suits investors who are clear about their risk tolerance and desire a steady asset allocation. It's crucial to remember that while owning a One Fund portfolio reduces the need for frequent monitoring, it doesn't eliminate it. As your life circumstances and investment goals evolve, so should your portfolio. In Australia, while target date funds are commonly found in superannuation funds, 11 ETFs that we'll be reviewing today are examples of target allocation funds. There are many benefits of owning a single fund portfolio. Number one is the simplicity and convenience. With only one fund portfolio, there's no need to juggle multiple assets or constantly tweak your investment mix. It's an ideal setup for beginners or those who prefer a hands-off investment style. The fund manager handles all the rebalancing based on the fund strategy, whether it is targeting a specific retirement date or remaining a set allocation between stocks and bonds. Next, diversification. One of the golden rules of investing is not to put all your eggs in one basket. And One Fund Portfolio offers a well-rounded mix of assets, spreading your investments across various asset classes. Another advantage is the disciplined investment approach. Managing your own investments can sometimes lead to knee-jerk decisions, especially in volatile markets. One Fund portfolios are managed by professional fund managers who stick to the disciplined investment strategy. Finally, let's talk about costs. Investing in a single fund means executing just one trade when you buy or sell, which can significantly reduce brokerage fees. Imagine having $500 a month to invest. Spreading these across multiple ETFs would mean racking up multiple transaction fees. While a one fund portfolio offers simplicity and ease, it's important to also consider the potential drawbacks before deciding if it's the right investment strategy for you. One of the main challenges with a one fund portfolio is its lack of flexibility. You don't have the option to adjust the asset allocation on your own. For example, if the market dips and you want to buy more of a particular asset while it's cheaper, you're stuck with the preset allocation. It can also be frustrating if you feel that none of the available asset mixes perfectly match your investment style, or if you dislike the specific funds included in the portfolio. Another drawback is the high cost of switching. These set and forget portfolios are great until your needs change and you find the asset allocation no longer suits your situation. Adjusting your strategy might mean potentially having to diversify into a 2-fund portfolio or 3-fund portfolio. While you'll save on brokerage fees by making fewer trades, this could be offset by higher management fees. One fund ETFs often have higher expense ratios compared to the individual funds they comprise. A one fund portfolio typically adopts a one-size-fits-all approach. While this might work for some investors, it doesn't consider personal investment goals like seeking regular income, prioritizing low volatility, or focusing on capital growth. And these funds are designed for the average investor, and unfortunately, not everyone's financial goals will align neatly with what's offered. On ASX, 4 fund managers, Schroders, Vanguard, BetaShares, and BlackRock offer multi-asset ETFs. First up, let's talk about Schroders. Their real return fund, ticker symbol GROW. Is the veteran in this space. It's an actively managed ETF aiming to deliver returns of 4 to 5% above inflation. The fund manager updates the portfolio quarterly, adjusting the asset allocation based on market forecasts and strategic insights. 7 years after Schroders' entry, Vanguard introduced their own suite of multi-asset ETFs, offering 4 different risk levels from conservative to high growth. In 2019, BetaShares entered the arena with 4 ethical ETFs. The exception is the BetaShares Diversified All Growth ETF, ticker DHHF, which is an all-equity non-ESG ETF. It diversifies across markets including domestic Australia, US, other developed excluding US, and emerging markets. Due to its unique composition, I'll exclude this ETF from our upcoming comparison. And most recently in 2022, BlackRock launched 2 ESG-focused multi-asset ETFs, one balanced and the other high growth. Since Vanguard, BetaShares, and iShares all have a spectrum asset allocation set, I will compare them based on each growth and defensive asset ratio. Before I do that, let's look at Schroders itself first. Schroders Real Return Fund's management fee is 0.87% with semi-annual distribution. There is a minimum initial requirement of $20,000 investment to be able to invest in this ETF. This fund aims to achieve a 4 to 5% excessive annual return on top of CPI, which is 3.6% by March 2024, meaning 7.6 to 8.6%. Currently, the gross assets, which include global equity and Australian equity, take 33.5%. A big chunk of the assets, 57.3%, spread to all different income-producing securities, including high-yield corporate bonds, credit, and even insurance-linked securities, as well as 7.1% in cash and 2.1% in commodities. Given these insights, the Schroders Real Return Fund represents a mixed bag. While it offers broad diversification and aggressive strategy aimed at beating inflation, the actual returns and the cost of investment might deter some investors, especially those looking for more consistent capital growth or lower fees. Moving on to the conservative option, only Vanguard has this option, Vanguard Diversified Conservative Index ETF, VDCO. The management fee is 0.27% and is a passive index fund. The ETF targets a 70% allocation to defensive assets and 30% to growth assets. The total annual return since inception is 3.46% with 0.59% in capital growth and 2.87% in income. The dividends are distributed quarterly. Currently, the fund has $2.8 billion in asset under management, including its twin managed fund, VAN0109AU. Let's look at its holdings. All the 4 options from Vanguard use the below funds as building blocks. I have to say the 37 asset allocation is rather conservative. Why do I say that? Let's look at Vanguard's own target date funds, the life cycle option. For investors aged 82 and older, allocate only 40% to defensive assets. And this highlights just how cautious the VDCO strategy is. With a total yearly return of 3.46%, VDCO's performance is modest, particularly when compared to some savings accounts that currently offer higher interest rates. Moving on to the 50-50 balance option, we have 3 candidates. Vanguard Diversified Balance Index ETF, VDBA, BetaShares Ethical Diversified Balance ETF, DBBF, iShares Balance ESG ETF, IBAL. Vanguard's VDBA is the most popular with asset under management of $8.2 billion. iShares Balance ESG ETF IBAL has the best performance, but it's partially because the market has been uptrend since the fund was launched in August in 2022. VDBA's total return is more closer to the realistic return that you would expect from the balance option. BetaShares Ethical Diversified Balance ETF has 3 underlying building blocks, and iShares has 7 underlying funds. Now, moving on to the growth option ETFs offered by Vanguard and BetaShares. When we account for the difference in management fees, Vanguard Diversified Growth Index ETF still remains an edge of 0.07%. This might seem small, but over the long term, even a small percentage can make a significant difference in investment growth. Now we have arrived at the high growth option, which aims for a dynamic 10-90 split between income and growth assets. Vanguard Diversified High Growth Index ETF, VDHG, is the most popular ETF with $9 billion in asset under management, but the most underperforming fund in this category. iShares High Growth ESG ETF, IGRO, performed the best, with 11% in capital growth and 2.4% in income return. It's clear that whether you're just starting out or looking to simplify your investment strategy, there's a range of options from conservative to high growth to match your risk tolerance. If one of these strategies resonate with you, take the next step and scrutinize the holdings and objectives of the underlying funds to ensure that they align with your value and financial goals. However, if you're feeling that a one fund portfolio might be too restrictive or doesn't quite fit your style, don't worry, there are plenty of other strategies out there. For instance, the classic 3-fund lazy portfolio could be up your alley. And this method allows you more control to tailor the weight of each asset class through separate ETFs, giving you the flexibility to adjust as your needs and market conditions change. My name is Irene. I'll see you next week.